Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Today we are going to talk about institutional investors like Opendoor, OfferPad, Zillow, iBuyers, hedge funds. The question is, do they drive up the market? Do they make it harder for people to buy? So let's start with, is it a coincidence, do you believe, that a few years ago, OfferPad, Opendoor, Zillow, these iBuyers came in and prices start going up a little, even though they're lowballing, even though they're coming in and buying up, they're not buying the top dollar, right? Okay, they're trying to get them cheap with a bunch of fees so they can flip and make money. Prices started going up. And then institutional investors came in, big hedge funds. Do you think that's a coincidence? Do you think it's contributory or the sole reason that markets is going up?
I think it's definitely contributory.
Because
they are purchasing homes in mass, and so they're reducing the amount of inventory available for regular buyers. So when that inventory pool is reduced, then what's left is more sought after, and so that's where prices rise. And then the other thing I think that played a role in it all is that these institutional buyers like Zillow and Opendoor and all these different hedge funds, they are not as price sensitive as a normal buyer, because a normal buyer has to qualify for a loan. It has to meet their budget. It has to meet their family needs. It has to be in the right school zone. It has to be all these things. But these institutional buyers are not sensitive to that. The only thing that they're sensitive to is doing the deal.
Okay, so let's talk about that really quick, because you get a disequilibrium in the market. So for some of you that don't know, I did spend a couple years in grad school studying business and economics and getting an MBA. So I have a good understanding of like how the economic part of this is supposed to work. Okay, anytime you have people with a negative incentive or disincentive to do something, or a false incentive, you create a disequilibrium in the market. In the last boom and bust we had, it was caused by a couple things. It was caused by these loan programs that anybody could get 5 loans, no matter how much money you made. You could buy a bunch of houses under the false belief that you could just hold it for a year, sell them all, make $500,000, then go back and buy 5 houses. Just do that forever, and it was going to work forever. And eventually it stopped, right? So that.
Right. So in the lending industry, they used to call those liar loans, because they were stated income, so you could put on there that you made however much money you wanted to put down.
Yeah, and it was so and a lot of the things that caused that were removed. So they basically made it much more difficult, and they made it back to how it should be. You should only be able to get a home if you're financially qualified. You can't buy a bunch of houses. It's actually kind of hard. Like it's actually
it is.
They put the screws on pretty hard, and because of that, since 2009, we've had a pretty constantly appreciating market, a very stable market across the whole country. Right. Okay, so now we have a pandemic. The Fed pumps a bunch of money into the economy. Banks and other institutions now are flush with cash because they're borrowing money based on federal funds. Federal funds, they have more cash. They can borrow a multiple of the amount of reserves they have, and they have to put all this cash somewhere. Okay, so you're a hedge fund manager, or you work for an iBuyer company, and your company has $2 billion in cash. Okay, you're being paid based on how many houses you can buy and how fast you can place this money. Maybe a little disincentive, and you realize you probably don't want to go buy stocks because it's risky, right? They go up, they go down. But what about real estate's a great place to put assets, and if you're the first one to place them there, you win. Isn't that right? Like you want to be the first one. So you have this rush of billions of trillions of dollars probably rushing into the housing market.
Right. And then the other thing is, keep in mind that these institutions are buying so many homes in these markets that they are in effect causing part of the skyrocketing appreciation, because they're taking homes off the market by buying them, reducing inventory, causing more demand, causing price increases. So they are causing their own properties to go up in value at an unusually high rate.
Yeah. So Back about 50 years ago, a couple brothers who were oil multi-millionaires decided they were going to corner the silver market. Of course, this is the Hunt brothers, and what they did was they went and they basically made this play to like buy up as much silver as they could get and run the market up, and then capitalize on the fact that they controlled the market. And it didn't work. Now, none of these companies are doing this intentionally. They're not intentionally out there gobbling up homes.
Well, they're doing it
to run up the market.
No, they're not doing it to run up the market, but they are doing it to park money in as a hedge against inflation, as their business model, because real estate assets work really well. Rents are going up. We've talked about this.
Right.
Values are going up. So real estate makes a lot of sense for them to put money in real estate.
Yeah, I think as long as there's a little inflation, that they'll keep the assets. I think you're going to see institutional investors own a large part of the real estate market. I think they're going to get very nice rental returns. I don't think they will want to sell. The only risk I see, and you can take it to the bank, because I've been saying there's not going to be a housing crash, and put that video right here. It's not going to be a housing crash. Is if something happens externally that causes them to need money, and they decide to dump real estate assets, and hopefully they're smart about it and they do it in small pieces. But the problem is, what if they just decide to dump a market? Oh, we need to get out of this market.
Right. I don't think that they're going to do that, because they're buying homes in so many different markets. They have the luxury of selling homes in multiple markets so that they are not causing their own assets to be devalued when they sell them.
Yeah, because they would have to really sell everything. Because let's say you sold half your assets in a market and you tank the housing market by $100,000, it might still be more than home values are today, but you're now depreciating all your other
right.
properties, and you don't really want to do that.
Right.
Now, a lot of these companies, they hold the market value on their books as what they paid for it. So if it goes down, they may not care, because they tell their investors, hey, we have this asset's worth this, plus it's producing income. And that's that's just the way that industry functions, mark to market and all that stuff. We went over that. I have videos from 12 years ago. We've been doing videos for over a decade. So videos from a long time ago, you can go back, you can just go click through the channel and watch super old videos. We look much different. I have a lot of hair. We're super young, and anyway, we're the first people doing this in Vegas, I think. So, what do you think about the iBuyers, though, specifically? Do you think they're going to stick around when the market starts tanking, given the fact that the hedge funds are keeping and flipping, but the hedge funds are keeping, but the iBuyers are flipping? They rehab the house and put it back on the market.
Right.
Do you think that is going to, if prices stop going up or if they start to tank a little bit, they'll still be able to do it? Or do you think they'll just try to skim and lowball and
I think they're going to keep doing it, because there will always be people who need to sell quickly, and these are an option for those people. So iBuyers, they're doing something that small investors used to do, right? We used to have all these signs everywhere, right, on cardboard saying, I buy ugly houses and that sort of thing. And those were mom and pop investors that maybe were turning 20 properties a year. But now, these companies obviously are turning a vast number of properties. It's the same principle. They've just done it to a much grander scale.
And I think the other issue is in the market, the people who cheer on everybody who disrupts old industries. They go, yay, they're getting rid of the way the real estate market used to work. It's not all, honey and roses and all that. And this is why. Those mom and pop investors were, they had to make money. It was, the $180,000 they needed to buy the house, flip it, and put on the market and sell it was like their money. It was, they were going to retire on that, right? They couldn't really take the chance on losing a bunch of money. If you've got $2 billion sitting in the bank because you've been funded by Silicon Valley, and you screw up a bunch of houses because you're just getting, you're just churning. You're just trying to churn through because you're making money off the loans, or making some money off ancillary revenue from some other thing. I think that there's a risk there, because yes, some people go, hey, I haven't been able to buy a house because of Opendoor, whoever, name your culprit, but they may not necessarily be making it. It's not like they're making a ton of money, right? Because when you get more competition, you're going to have less
Right.
margins.
Right. But at the same time, they're doing it, the Open Door and Zillows of the world, they're doing it on such a scale that they don't need to make that much money at the end of the day because they're doing so many of them. So that's part of the game that they're playing. While a mom and pop situation, they need to maybe make a little more money because they're not doing as many properties as these big conglomerates are doing.
Well, it'll be interesting. We won't really know for a long time. There are a lot of companies that have been operating now that many of you have heard their name. Uber's one of them, right? Have they ever made a profit? No. But you say, oh, but they've dominated the industry. But they haven't made any money. They're not really returning any value to they're returning stock value, expected future value to their shareholders, but they don't make a profit where they can return dividends and things like that. So we'll see, right, how that model, what happens with that. So that's where I see these guys. The other thing I'm wondering is, do you think that these companies, to some extent, because they are flippers, they take a house, they fix it up and add some value, and they sell it for more money, that they are pushing home prices up in certain markets because they're actually taking a house that's worth less and selling it for more, so here's an example. You live in a neighborhood where all the houses used to be $250, but they're old, and then they come in and buy one and flip it, and they sell it for $280. And because people, it's been fixed up, it's really nice, got everything brand new, so they pay $280. And then the next guy go to list his house with an agent, and they go, well, he got $280, I want $280. And like, well, but they fixed it up. He goes, yeah, I want $280. So they get $265, which is more than it's worth, $250. But an appraiser goes, well, that's sold for $280, so I'll figure out a way to make this worth $265. And it pushes home values up. Do you think that there's something in that?
Oh, absolutely, because appraisers look back. And appraisers don't necessarily care how much money was put into a property to get it to sell for that $280.
They don't know.
Well, they don't know, and they don't care. That they're more about crunching numbers than looking at the quality. And that's nothing against appraisers, but appraisers kind of have a different philosophy than maybe buyers do. And the converse is true too. When an appraiser is told, hey, we had 35 offers on this property, what do you mean that this property doesn't appraise for the purchase price? Again, they're looking back and they're saying, look, I don't care how much demand you have for this property. The last property sold for $280, it's only worth $280, and that's it. So it does cut both ways on the appraisal end.
Yeah. Okay, so institutional investors and Silicon Valley, call them startups, but they're not. I think they're publicly traded, or very soon will mostly all be publicly traded. Certainly Zillow's publicly traded. These companies are here to stay. They have a lot of money backing them.
They do.
Because of fintech. And we're going to do a whole nother video on this, but they're here to stay.
Yes.
I think they're here to stay. I think the existing model will still be around. It'll still work for a long time. We're not going to be like Australia and some of these other countries where they have a completely different real estate model. But we'll do a whole nother video on what the market is going to look like in 10 years. We'll make that another video.
Sounds good.
Okay, so ultimately, synopsis now. iBuyers, hedge funds, flooding the market, buying up homes. Not only are they driving up rents, they're driving up prices because it's supply and demand.
Absolutely.
And right now on the horizon, we don't really see that tapering off yet.
No, and there's no reason why it should. There are so many of these players in the market. There's nothing to discourage them from being here. There's only encouragement for new players in the same vein to come into the market. So the more of these institutional buyers we have, the more this is a machine that will just keep churning along, and the prices will keep increasing, the volume will keep increasing as properties are being sold, and the inventory will keep decreasing because we have these conglomerates that are not price sensitive the way an individual buyer is, and they are here to buy real estate, and if they're interested in that house, it's going to be very hard to beat them out because they don't have to qualify for a loan, and the house doesn't have to meet all these wonderful requirements that it has to meet for an individual buyer.
Yeah, I agree. Well, the only way you're going to know if we're right or not is subscribe to the channel and then watch all the videos that we do, so that in 6 months, a year, 2 years, when we do another video where we talk about what's going on in the market and iBuyers and hedge funds and Wall Street funds and things like that, and we'll be able to see what actually happened.
Absolutely.
But you won't know if we're right or wrong. I kind of have a good idea. So I'm gonna leave it with this. I don't believe in the short term the market's going to drop, and I always tell people, if you think the market's going to drop, then go sell your house, like sell it and take the cash, and then go rent and wait for it to tank again, and then come back and buy some more houses. And then usually I get kind of I don't know, really want to do sell my house. Okay. So anyway, it's something to think about. If you like the video, subscribe, hit the notification bell. Our contact information is below. If you're looking to buy or sell in Las Vegas, we can certainly help you. If you're looking to buy or sell anywhere in the US, we can help you with Referral Cloud.
Yes.
Referral Cloud is a platform for real estate agents to transact their referrals. We can certainly find you a good Referral Cloud agent anywhere in the US that would help you buy or sell.
So like our video, please. We like your love. And leave us your comments, leave us your thoughts. What do you think about these institutional buyers? Are they here to stay? Are they a passing fad? Let us know what you think. We're interested in you.
All right. Thanks for tuning in. We'll see you on the next video. Bye.
Bye.